Good afternoon and a warm welcome to all our clients and intermediaries. It's an absolute pleasure for me to be with you this afternoon in another webinar from Sanlam Private Wealth. The purpose of this webinar today is to specifically look at the retail sector. What is the impact of COVID and the current global environment on the retail sector in South Africa and globally? And to help us to think through this process and to understand the sector and the impacts significantly better is a very good friend of ours and the chairman of Woolworths, Hubert Brody. So Hubert, thank you very much for joining us this afternoon. We're really looking forward to your insights. So with any further ado, I would like to introduce you to Alwyn van der Merwe, our Director of Investments, to take you through his view on the retail sector, and then Renier will take questions we'll ask Hubert questions. Thank you.
Thank you very much, Carl. Good afternoon, ladies and gentlemen. It is indeed a privilege to share a few investment ideas with you this afternoon. I think all of us, we are very well aware of the fact that we live in a world where we experience a technological revolution that fundamentally changed the way that we live, that we behave, and that we do business in, and how we relate to other people. And this revolution, I think, has changed the way that our habits evolve and that we behave. And I think very importantly for businesses, it also changes the way that businesses do business and that they think about strategy when they look forward. Importantly for us, though, is that the storyboard of the investment world has changed over the last few years. And what we've seen is that this storyboard has had a major impact on the way that both retail investors and professional investors, in fact, the way that they assess companies for their investment merits. And what you normally find in this kind of environment is companies with a very good story trade at very high valuations, and companies that are associated with the old economy trade at very low valuations. Now, when you start to talk about the retail industry, they couldn't escape these trends. And within the retail industry, some of these companies are on the forefront of the digital revolution, and some of these companies are perceived to be laggards. And the ratings of those companies reflect exactly that. And I'm sure that Hubert will talk to us about that when he addresses on the sector. But I think it is very important that you as clients should understand how we think about it when we construct portfolios to ultimately generate returns and manage the risk in your portfolios, how we balance valuation with the storyboard that we need to deal with on a daily basis. So I thought I wanted to share a few slides with you in terms of the retail sector, and just for simplicity's sake, I'm only going to focus on the South African sector. But before I touch on the slide, I just want to go back to the storyboard. I just thought I'll share one example with you in terms of how the storyboard dictates the valuation of shares. If you look at the two biggest retailers in the world, number one, Walmart, in terms of turnover. Number two, Amazon. The market cap of Amazon, 1.5 trillion US dollars. The market cap of Walmart, 360 billion US dollars. So the one is 5 times more the value of the other one. The interesting thing is that if you compare the revenues of Walmart and Amazon, Amazon only sells about 60% of the value that Walmart sells. And I think a lot of the principles that made Walmart successful in the previous regime are probably the principles that Amazon embraced in this new environment. Nevertheless, Amazon trading at 116 times price earnings multiple, and Walmart trading at a 20-odd price earnings multiple. So there's an immense spread or difference between the valuation of these two stocks, and only because they fit the two different parameters of the same kind of storyboard. Let's go back to South Africa. I think What I show you on that particular slide is just the price performance of the general retailers in South Africa, and it goes back to the mid-90s. And you can clearly see, if you look at this slide, that there are periods where the sector simply goes sideways, then phenomenal performance that we've seen from the early 2000s up until about 2014. And then since 2014, the sector went sideways. And then if you look at the last part, the sector came under immense pressure. The point to make is that if you look at this, and if you look at the next slide, which simply shows you the relative performance of the retail sector versus the all-share index or the average share in South Africa, that there are times when you want to own this sector. So that has been reflected by that orange line. And there are times where you don't want to own the sector. That is been reflected by that red arrow that you will see. So it is a sector where if you engage in investing in this sector, there are times you want to overweight and times that you want to underweight in the sector. Now, when do you want to overweight and when do you want to underweight? That is, I suppose, that is the question. Now, if I just look at this slide and I forget about anything else, I would say the times where you want to own it is after a period of underperformance. In other words, at these bottoms, there back in 2007 and 8. And if you look at this particular point, if history is going to repeat, I think you would argue that you would like to buy that. You will only buy it if you're a contrarian investor. Because we all know that the story associated with South African retailers at the moment is not necessarily a positive one. And the reason is quite obvious. We sit with very high employment rates. We sit with disposable income that is under pressure in South Africa. And we sit arguably with a somewhat uncertain future for South Africa as we look at the situation today. So that is the one thing. The other thing that we used to use as a very handy tool to look at when to include retail shares in our portfolios is to look at the pattern or the direction of interest rates. And if you look at this particular slide, the direction of interest rates has been reflected by the brown or orange line. And unfortunately, to make it fit the slide, I've inverted that. So when that orange line goes up, it means that interest rates are falling. And if you look at this particular history, you will see that normally when interest rates are falling, the green line goes up. In other words, retail shares outperform. Retail shares outperform. And of course, when interest rates go up, in other words, the orange line goes down, retail shares underperform. Up until that point there. And since the middle of last year, you can see that interest rates started to decline, but unfortunately, retail shares went into the opposite direction. Now, what we've done in our portfolios over the last 2 years, we started to accumulate retail shares for two reasons. Firstly, we thought the shares were very cheap, and being very price sensitive when we build portfolios, we thought it was a good idea to start to accumulate them, knowing that the macro environment was quite tough. And I've got to make that point, Carl. It's not that we take these decisions simply on price. We understand that the environment is tough, but we thought a lot of the bad news was priced in. And also, we knew that interest rates overseas were low, and South Africa at some point had to follow. But now you can see, for the first time in this history that I've pointed out for the last 20-odd years, interest rates declined, but the retail sector continued to underperform its peers if you compare them to the average share in South Africa. Final slide. Why is that? The reason actually I think sits at the numbers that if you look at the growth in retail sales, if you look at that red line, it is really as a result, I think, of very dysfunctional economic management in South Africa, ultimately led to a serious structural decline in retail sales in South Africa, and investors are simply saying, I don't want to invest in a sector where it is very hard for us to see what will turn the momentum around in terms of retail sales. So it's almost as if the market is saying the sector can't get cheap enough before we engage in investing in this sector. So I think, Hubert, when I turn to you, the question is, the old set of rules that applied for retailers and retail investors in South Africa, does that still apply? Or is it indeed a completely different world and a different scenario where we have to take decisions in?
Thank you, Alwyn. I think we will get to a bit of that discussion as we go. But firstly, Carl, thank you for inviting me to come and to join you for this hour. It's really pleasant to be at Sanlam, to be at your offices here. And I spent a couple of years of my career since after I moved down to Cape Town, working for Sanlam, and it was really a very fascinating time in my career, and it was a little bit like a postgraduate phase in the insurance and investment industry, and I really treasure that time that I had with Sanlam. So it's nice to be here again. But let us maybe talk a little bit just about some of the broader trends out that affects retail across the world. Also sort of in a Woolworths context, being a corporate retailer with a couple of brands. Let's talk about some of those. Then we can maybe speak about digital and the impact of that. And also particularly in what way has COVID affected retail. So I'll just cover a little bit of that now. So a number of the forces, shall we say pre-COVID, which we would keep in mind as a corporate type of a retailer like Woolworths. And keep in mind, we're not only in South Africa, we also have the significant businesses over in Australia. So the first force, maybe not in sequence of importance, but the first one is actually your specialty stores and your line stores. Those competitors that you have that are very, very dexterous, they can change their styles, their product, their way of presenting, the way that they where their stores are, etc. very, very quickly. It's normally just a couple of stores or only one that's owned by someone, and all of the passion go into that store. And we have to keep all of those specialty stores strongly in mind when we compete out there, because they chip away at us, the larger corporate retailer, and particularly I'm talking about fashion now. Also, food a little bit more on the niche side of food, but particularly on the fashion side. So what the specialty stores do, where they open up on a tactical level, and how they compete with you, is quite a challenge. Another important force, maybe just on speciality, one other point is that we have some speciality kind of brands. In a business like Country Road in Australia, we have sub-brands, and there's very personal service that is actually provided with those sub-brands to our clients, but it's not easy to imitate that real personal service that you get from those smaller competitors, and we have to have other ways of playing in the market to compete with that. Then the other force that is out there is that customers really want to interact with you as an organization and as a brand. It is not only sort of online and arm's length and stuff gets delivered at your, let's say, at your house or at your premises. Customers want to interact with your brand, whether it is online, whether it is digital, whether it is in many social ways on social media, and also in your stores. And they want to experience your brand, and not only what you stand for, but there needs to be some kind of an experiential aspect to that, how we interact with our customers. Some of the real big successful department stores like Selfridges really get that right. If you go to Selfridges in London, you would see the experiential aspect there, even from streetwear right through to the food and so on, how that gets experienced. And I guess in a Woolworths context, if you look at our food stores, customers really feel that they interact with our product. It's rich in content when you walk into the store. It's rich in quality information than when you're in the store. And there's also a bit of theatre and a bit of experience as you are there. And customers are looking for that physically and also in the online and in the digital space. And that's a very important part as this industry is transforming as far as the role of the physical store and customers also want to touch and feel the product, but it's a different context how that now happens than maybe the way that it happened 20 years ago when there was absolutely no online. Then the significant force that you spoke about, and the example of Amazon that you gave, naturally is online. And if our clients out there, that if efficiency and just getting the product in the hand is the only thing that is important to them, then you don't look anywhere else but online. Particularly now, the delivery sort of very often next day. Delivery that takes place, and delivery and logistics has become so efficient. Even return logistics of product has become so efficient. So then it is purely an online play, and then it's about competitiveness on the websites, in the mobile space, and digitally, about what is the richness of content that you provide customers, what is the efficiency and the user experience of your digital online interaction, and also obviously the delivery of product. And this impetus that online is getting and the momentum that online has for the efficiency seeking customer, that is asking big questions of retailers as far as their channel choices is concerned. So this is a channel choice. How do you? It's a channel choice conversation that takes place at the retailers. And what is the ideal mix of channels? Delivery channel, physical, digital, and other out there. And also, what is the correct mix of communication out there with customers? And is retuning and resetting that for the world out there, and also keeping in mind the experiential aspects that I was speaking about. And in that context, I think COVID has actually fast-forwarded us somewhat. There's always been this evolution, and it's actually been quite a fast evolution. I think you used the word revolution for some time from an online point of view, but this evolution probably there was a leap in the evolution, a bit of a mutation that's taken place. Now, if you were to look at an evolutionary kind of analogy, and the mutation is because of COVID, and a number of critical jumps was made. For example, work from home, just to use one, we can speak about others maybe later. Work from home is such a significant thing now, which it wasn't. Now, what is the implications of that as far as online is concerned, and for example, getting your lunch delivered at your house, for example, and not walking out in the street and buying it at a restaurant as you would have. So those kind of impacts. But it's about channel choices, and it's about how has COVID actually fast-tracked certain of the impacts of online. Another force in general that is out there and very much affecting retailers, because retailers are on a day-to-day basis in contact with our clients, and is very relevant in a client's daily mindset, is the social responsibility of you as a corporate and as a retail corporate. And you have to be absolutely honest about what you stand for from a social consciousness point of view. You probably have to have a cause that you stand for, and then everything else that you do, right up into your supply chain, has to be ethically, absolutely spot on and ethically honest what you do. And if you get that wrong, you could probably find that a teenager can take you out at your knees, through starting an online or a sort of a social media campaign. So that's a significant other force, and you get caught out if you are not honestly actually positioning yourself correctly for that. If it's just a fake or a sort of a mask that you put on, it is not sustainable, and that asks big cultural questions of one as an organization. So those are some of the forces that's out there, and that we have to consider. It's not only an online question; it's also a number of other things that are coming with the changes out in the world. And very briefly, COVID has been an interesting time, and there's a number of important learnings that's happened through COVID. I mean, one of the most basic learnings is how dexterous one must be and how quickly one should be able to pivot. I think our kids have also learned that the world is not not always predictable, and that things do change and situations occur where you have to actually operate in a very, very different way than what you've operated before. And for example, the way they've written exams, the way they've gone to school, and as you know, you learn a lot of wisdom gets gained in times of hardship and times of challenge like this. So I think we've all become quite a bit wiser in that there is another way. And so the corporate world has also, I think, become a lot wiser in its dexterity and being able to use other methods of operating. I mentioned work from home as one example, digital. And maybe just a final point here is that when you are in a tough situation, like what just about every business was over the last 6 months or so, it's that saying of when at low tide you can see who's not well dressed. And I think you've been shown up in your business if you don't have strong fabric in your people, if you don't have people that can think of their feet, if you don't have perseverance in your approach, and again in the fabric of your management. If your capital structures are not healthy, one was shown up, and if you were not digitally adequately enabled, you were shown up as well. So that's a bit of a lie of the land of how I see things have developed and what some of the important forces out there are at the moment.
Thank you, Hubert, for that introduction to some of the forces of retail globally. I remember Hubert was appointed as the CEO of Imperial about the time when I started my career as an analyst. And I built up quite a lot of respect for you because I think it was quite a difficult time at that stage. It was just before the financial crisis. You had to navigate through there. Imperial had quite a lot of debt that you had to restructure. And I think what you did well was just to refocus the business on the areas where you were strong and especially where you can allocate capital quite efficiently. So I think Imperial certainly became a much more streamlined and efficient business under your watch. So I think you should consider running a state-owned enterprise for us for a while. So I'm sure you can use some of the efficiencies there. But perhaps if we can talk a little bit more about retail and globally over the last decade, we've seen quite a large number of retailers globally filing for bankruptcy, those that were around for quite a long time. And it wasn't necessarily a lack of disposable income. It was more due to changes in consumer patterns. And it seems like retailers often die of old age as the new generation resonate with new brands. And we really only seen a handful of retailers successfully transition to become successful in modern retail. So can you perhaps give us a few examples of those few who were able to transition and what differentiated them from those that actually failed?
Okay, I'd gladly do that, René. Thank you. And I'd just like to remind you that when I became CEO of Imperial, the first business that we ditched was our aviation business. So I might not be a good person to be in a SOE. Who knows? But yeah, we did a lot of those things those days, and some of the businesses that we exited were our capital heavy businesses, and that's not different in a way from businesses which have got big lease portfolios, because that's also capital that one has on your books. So some of that thinking one can actually bring through even into the retail industry, that you must get rid of drag in one's business, and inefficient drag is such an important thing to be able to recognize in the business and to carve out of a business. It also depends on the times that you're in. Things which are inefficient on one day might not be inefficient on another. So But so let's just talk a bit about which retailers that's been able to very successfully kind of reinvent themselves. And let's rather ask the question, which retailers have actually fallen by the wayside, and why do retailers fall by the wayside? And I think the ones which fall by the wayside are retailers that have not stayed relevant. It's all about relevance, you know. If you are not relevant within the demographics of the country or the regions in which you operate, if you are not relevant as far as the values of your consumer and of the customers that you serve, if you're not relevant as far as the way the customer want to actually get hold of the product, you know, it is either not reading the relevance correctly, or it is a case of not being able, even seeing it, but that you're just too much of a dinosaur and you can't actually go through, adapt to become that organization that you should be. But to give you a couple of examples of sort of success stories, our success stories abound, and not only digital success stories. I mean, I mentioned Selfridges as one example, and keep in mind it's not only Selfridges. There's the 3 Selfridge stores in the UK, but they're part of a group which includes Browns, it includes Bijenkorf in the Netherlands. They're part of a group of about, I think, 30 or 40. There's Canadian stores as well. Very successful department store group, and in that particular case, they've stayed relevant, they've stayed young with their customers, notwithstanding that they are a department store, notwithstanding that you would think their customers would want to go to a specialty store, and they've created great experiences and a great digital presence. But the store is still where the action is. So there's Selfridges as an example for you. Then you could look at something like Next. I mean, Next has about 4 billion pound sterling of turnover, and approximately half of that turnover is online, and the other half is store. So they've been able to get this balance right. They're a very profitable group. They still have 500, 600 stores. And even during this COVID situation, and it's a bit of a miracle if you think about it, they're still going to make 200 to 300 million of profit, pounds of profit, and so that's very good interplay of channel choices, and obviously being large and having a strong hand also to negotiate with the landlords plays a role. Nordstrom is another group which have been able to shape themselves into a number of formats. You know, you've got Nordstrom Rack, you've got some of the Nordstrom, you've got this traditional Nordstrom, then you've got the Nordstrom stores, which are purely a digital experience where you can select your products. So they have actually differentiated inside of their delivery, inside of the delivery channel itself, and obviously a online presence. Maybe to think of just one other example, and a bit contrarian to Alwyn, is even Walmart. You know, they might not be on that PE that Amazon is on. Amazon has a bigger problem with their PE, I would say, than what Walmart has got. But Walmart has certainly been able to introduce digital very, very successfully into their organization. They have a very big digital and online offering. They have great expertise, but they've put their money where their mouth is. They told the market, we're going to put this capital into an online proposition. They went out, they did that, and it's a great flourishing and successful organization still. And they're certainly not a dinosaur that's dying off, you know. So there's a couple of the good stories, and there are many like those.
So one of the most important responsibilities for a board is to ensure that you have the right leadership in place. So if we talk a bit about Woolies, we know that the food business have been doing quite well, growing market share over many years, but they've been struggling on the fashion side, both here in SA and in David Jones in Australia. So tell us a bit more about your recruitment of Roy Bakatini, which recently joined as the CEO of Woolworths. at the start of the year, and he was specifically recruited from outside of the group.
Yeah, so we're very happy to have Roy on board. We absolutely believe that he's the right person for this particular set of challenges that we have. And Roy has got a couple of skills which were particularly attractive to us during the process. It was a very wide search process. We have significant skills inside of the business as well. But for the situation which we are in, where we need quite significant international experience, and we have particular turnaround challenges in one of our Australian businesses, David Jones. On the other hand, the person must also have strong apparel background, which Roy also has after his 6 years at Levi's, and the large portfolios that he's run at Levi's. We think he has a good portfolio of skills for the particular situation which we are in. But one person is not going to make all of the difference in an organization. So for a while now, there's been some changes at Woolworths. For example, last year, 5 new directors came onto the board of the group. A number of people with very strong retail background, South Africans, British, Belinda Earl from the UK, an Australian gentleman by name from Chris Colfer is on the board. So we have a good retail mix of new board members, some fresh thinking that we've brought through, and some others that has great leadership sort of background. For example, Clive Thompson, previously the CEO of Barlow World. So you kind of have to start off with your board and make sure that you have the right mix there of people that has the history in the business, but also then a critical mass of good experience but new thinking as far as one's own business is concerned. Then we have a new person in Janine Wormsley in our investor relations job. We have got importantly Mani Maritz from TFG that had great success there. That's now in charge of FBH, our fashion business and home business in South Africa. Very important business for us to reignite, because there's so much potential there, and absolutely no Mani will do that. And then because of all the restructuring that we've done, we've also pulled on a contract basis, but he works for us, Rob Leith in. Rob Leith was a very significant player in the Old Mutual process and the restructure that they did. A lot of international experience. So there's a couple of new people in the team at various levels across the business, and I think that sort of critical mass of change, combined with the deep experience and some of the very strong players that we have in the business. For example, Sam Gumeni and Zyda Rylands are absolute stalwarts of Woolies, and they bring that deep understanding of the Woolies values and so on through in the business. So number of people changes, and very happy that Roy can head up that team.
So we've got a lot of new fresh faces in the board with quite good experience. We've got some new management at the top. Is it now time to have a fresh look at department stores and specifically David Jones? Do you think the previous management really underestimated, sort of how big a challenge it would be to transform David Jones, given the structural headwinds against department stores? And do you still see that as a future in Woolworths, either in its current format or perhaps a different format?
Neer, it's interesting. All of us can now quite clearly say that there is no doubt we should not have bought David Jones, or more specifically, not at that price. It's now a very easy thing to say, and we all do. But if you go back to the dynamics at that time, 6-7 years ago, and you also go through the reasoning that we had as a board. I actually came on sort of at the end of that, but I'm a very well au fait of the reasoning of that. There's a lot of merit to the thinking at the time of a regional Southern Hemisphere leader in fashion and apparel, and the economies of scale that would bring, and the competitive might that would bring. And it's not easy it's hard to fault that as a strategy at the time, and also, I mean, many clever people also believed in that. I mean, otherwise the share price wouldn't at the time have gone. So we weren't on our own in having the belief that it's a good plan. But a couple of things did happen, and one of the things is the Australian economy and the retail part of the Australian economy and the underpin of property in Australia became less strong. It's always strong, but less strong than what it was. There was also an influx of a number of international retailers that moved into Australia at the time, and the Australian market became very promotionally driven. And promotionally driven basically meaning there was discounting all the time, and like the starting point after a week or two of a product being on the shelf, it starts being put on sale. So that makes a big difference. You really are with your back against the wall when your GPs from the outset, and very soon after we did the acquisition, were under that pressure that the GPs were. But we also have to very manfully acknowledge that we executed badly. We made a number of mistakes in the way that we implemented, in the way that certain projects were run, and how we transformed the business. We had good plans, but not well executed. And I think that that's not great, and we must do better in the future. But as far as David Jones is concerned, it's a part of our group. It's been written down to a value approximately 800 million Australian dollars, and we've recently had another good look at the valuation of that, for whether that needed further impairment, and we came to the conclusion that it didn't. So we obviously believe that there's value in the business, and we must trade that business hard now. Now that the projects have settled down and a lot of that transformative things have been done system-wise. Elizabeth Street has been our flagship property, has been complete, and we are in there, and it's a world-class department store, and it's an icon which puts a halo over the whole. We must now trade that business hard, and then we must see what develops out of that going forward.
So you mentioned with your introduction how important it is for a corporate to stand for something, and it seems like there's a lot more social pressure these days on companies to be good corporate citizens. We know that the world is challenged by things like inequality and climate change. So how do you think retailers specifically can play a role to give back more to society?
Yeah, there's no doubt that retailers can, particularly because we have a physical product that reach our customers. So in that whole supply chain of that product, there are so many places where the ethics of the production of the product could be wrong and can be righted, can be corrected. In not only the production of the labor that actually goes into it, the whole supply chain, as we call it, running a good business journey right from the crop right through onto the shelf, and the sense of responsibility that Woolworths deeply has for that is very, very well known, and we live that set of values. And also, I think during this period of COVID, which is by no ways over, because a lot of the economic implications is still with us, and of the human suffering is still to come. But during this period, I think Woolworths have again showed its mettle as far as a responsible citizen and a responsible retailer is concerned. And the amount of food redistribution that we've done for people that's been disadvantaged during COVID, and so it's massive numbers that we have done. The 1/3 of salaries and fees that directors and many staff members have actually forfeited for 1/4 of the year. That was significant. That absolutely came from the heart, and that actually showed where the value set of our people are.
Okay. So a few years ago, we've seen many of the South African retailers, fashion retailers, move a lot of their sourcing offshore to China, and I guess now with the weak rand and the fact that retailers need to be a lot more flexible in supply chain, you see the desire that they actually want to start increasing local sourcing again. But in the meantime, there hasn't been a lot of investment in local manufacturing. So how can Woolworths or other retailers play a part to really reignite the local clothing manufacturing industry?
Yeah, we certainly can. It's a relatively slow process because the infrastructure of the local garment industry have over the years become, have aged, and there's a lot of renewal that needs to take place in the infrastructure. Maybe not only South African, but there are other African sources of Mauritius being one example, and some other states around South Africa also examples, which we can which probably has an even slightly more ready supply and production facilities and production base of garments that we can support and that we are planning to support. Yes, it's a currency thing because the rand is, but on the other hand, they don't have the economies of scale that some of the Chinese have. So a lot of the currency advantages gets negated by not having economies of scale. On the other hand, we well known, and we've done this on the food side for a long time, that we actually support suppliers and we make sure that suppliers succeed, that they follow the right ethical routes, but also that they have the volume and the infrastructure to succeed. And what it will help us, and this is particularly a fashion issue, is a shorter supply chain, and therefore you can pivot your product much quicker, and you can adapt quicker to as you see through the season, a certain line works and other lines don't work. You can pivot and you can actually adjust the supply, and you can still, during the season, have manufacturing take place. And you can't do that when you are ordering from, for example, from China. So there's a lot in that, but together with government, we will have to develop the local industry.
Maybe adding on to where Alwyn started, it seems like from an investment point of view, the retailers really look attractively priced, but it's hard to get excited about the economy. We know we face quite a lot of challenges. You sit on quite a few boards. You probably have quite good insights in how companies think about the future. So maybe just share your insights on whether you think there's any reason for optimism again. Will we have another strong consumer cycle from this point of view to really to help re-rate those share prices?
Yeah, look, I think the one point I'd like to make is, look, I'm not the share valuation expert here, but this is all a relative game. You could find that even in a weak cycle, something can be oversold, and that there's just so much negativity. And as you know, the pendulum always over oscillates both sides, whether it's excitement about a particular stock or a particular industry, or whether it's negativity about it, you over oscillate. And the question probably to ask is, has it over oscillated, even though we are in a tough economic environment? I guess you ask exactly the same question about the banks as an example. And then you have to get specific, and you got to say, okay, Woolies is not only a sector story that you have to think through there's structural aspects to Woolworths, and there's restructuring that's taking place. You know, how much value is there to be unlocked in Australia? How much value is there when FBH, our fashion business, starts firing again? Notwithstanding a tough market, there's market share to be regained for our fashion business, no doubt, because Woolies is an incredible brand out there which has got a following. We must just provide the product that our customer want. So it's I'm not going to give you the answer. I can give you some things to think about. That's the case with Woolworths. The one thing I could say about Woolworths is everybody breaks their heads or put so much effort into thinking about the David Jones conundrum, and it's the big news in the newspapers, etc. But I think one must think past that. I think in just about every valuation of David Jones has been written off to zero, I presume. So put that aside. Ask yourself the question, what is the value of Country Road, which is that iconic Australian brand, if that's properly liberated and unshackled from David Jones, which I have a level of confidence that we know what we're doing and we will get that right. And also, if you look at our fashion business, when we just regain the natural market share that we should be filling, what is the value of that business there? And one must stop reading the sensationalist headlines and you just look at the operations and the core components of the organization, and then I guess there's some optionality in David Jones, which is a plus something or null, but there's so much value in other things to look at.
And you've got the property as well.
We have properties in David Jones, that's quite right,
Yeah, so final question from my side is just, you are a current board member at Nedbank, you have some executive experience in the financial services industry. So we'd like to probe your insight just into the banks during the COVID crisis. We know that the economic impact of COVID is larger than what we've had during the global financial crisis, but certainly the banks are much better capitalized during this crisis, and also the loan growth has been a lot less exuberant. So the banks haven't been the bad guys in this, right? But nevertheless, their share prices have come down quite materially. So how confident are you that our banks will be able to survive this crisis from a capital point of view, and do you believe that our banking shares actually therefore offer good opportunity?
Yeah, I think maybe just the first remark, which is very interesting, is that the banks actually played a very interesting role during this pandemic crisis. Whilst with the GFC 12 years ago, the banks were relatively thinly capitalized, and the game in town was to be thinly capitalized. But then when the crash came and there was a crisis, there was just not capital to handle the punches, and that so many banks fell over at the time. Whilst now, because banks were so well capitalized and all the actions that were taken by the banking regulators over the last 10 years, banks could actually play a shock absorbent role during this crisis. And there was a lot of guidance that came from the regulator in as far as guiding banks to provide a certain type of loans, and then you would not have to carry any capital penalties in order to help consumers, to help industry at large through the shock and being shock absorbers. And notwithstanding playing that role, I think banks have come out very well capitalized on the other side of it. It looks to me, if I look across the banking industry, that banks have put very big provisions away during this time, and that's what you do if you're a banker. When it's down, you put it away, and that then carries you for a number of years. So I'm not the expert on valuations, but that South African banks are in good, healthy shape, notwithstanding the crisis. I have no doubt about that, and they are in a position that they can grow loans and can grow advances whenever there's a recovery going forward.
A lot of effort is going into the business to steady the ship in certain areas, and I'm sure, given the personnel changes, to turn certain areas of the business around. Once the ship is settled, I think the one thing that we've learned from the last set of results is that the balance sheet is in fact in very good shape. Once the ship is settled, to get back to my theme, the story that sells at the moment is, where can we get growth? Where would Woolies go and look for growth? Particularly with your background as a person with a good reputation as a capital allocator.
Look, I think Woolies we have been somewhat distracted by, as you mentioned, by particular projects, and particularly in Australia, and even some of our good resources. We had no choice but we had to apply them in Australia while they should have been here, but could not have been here because they needed. And I think the ship is stabilized. I don't think that's an issue. As you say, the balance sheet is exceptionally strong, and I think surprised everyone how strong it is and how quickly we could pivot. But the growth in Woolworths, I mean, our food business is absolutely correctly positioned for this post-COVID type period, where people are we're eating out and rather eating in, and looking for meal solutions, wanting to be at home. People being back, wanting to be in their home comforts, what they call sort of nesting, and also which goes together with work from home. And so there's no doubt that our food business has got a lot of run in it in the long run. Whether next year and immediately it's going to have a kind of a surge or not, I can't be that specific, but that it is well positioned for a transforming world, and for people looking for meal solutions and looking for that experience that you want in a store, and being world class in many ways. There's a lot of legs in our foods business. I've mentioned our fashion business has got. I mean, we just need to regain some of the market share that we should not have lost, but which we have lost. It's a strategy thing, and it's an operational implementation thing on the fashion side. So Country Road is a great business, and if we can unshackle that from being burdened and being too concerned about the David Jones things, I think Country Road is in a good space. It's got great Australian brands, and again, Australia will buy more Australian in this time. When there's difficult times, you go more local and you go more casual, and I think that's also why that product set is well positioned.
Hubert, thank you very much for the answers. And so if I can maybe just quickly move to Alwyn. So Alwyn, questions: how will second wave COVID activities impact our market locally and abroad? Do we climb out now and buy back later?
You know, in every question, there's almost a question that is not being asked. It is quite clear that particularly in Europe, the COVID cases are building again. But I think there is certainly also a bit of uncertainty about how you should handle that from a policy perspective. So if the increase in cases does not lead to economic restrictions, theoretically it shouldn't really have a massive impact on the economies, and it shouldn't really then have a massive impact on the earnings of companies. But of course the market will not like that, because it does have an impact on the daily sentiment. However, it's also true to say that you might get a positive surprise that you might get a vaccine. And in fact, there are, I think, about 5 vaccines that are in stage 3, which means it's just before the stage that can actually use it in a more broadened way on humans. So you can get a surprise there. So we would not necessarily like to build a strategy on whether COVID is going to increase or not. But what we can do is to say, what happened to asset prices over this period? And I think what the average asset price in the equity market it was priced for a V-shaped recovery in economic activity and also in company earnings. And I don't think we are going to see a V-shaped recovery in the short term. So therefore, there are certain sections within markets, to our mind, that are expensive. And those are, by and large, the companies that benefited from this wonderful digital story and that actually came through the whole crisis very well from an earnings and a profit perspective. But in the meantime, the more cyclical companies where the earnings were under more pressure, they got seriously penalized. So it's not a wholesale sell that I would suggest, but I think globally there are some shares that are too expensive. And for our clients that actually follow what is happening in our global equity portfolio, you would certainly see that there's been a bit of a rotation, not a wholesale rotation, but we have, to use Hubert's words, we have pivoted out of the more expensive stocks like Facebook, like Microsoft, into cheaper stocks where we still think that over time those companies can generate a reliable income and a cash flow stream. And we've bought some of those, like Bayer, for instance. In fact, I bought this afternoon for one of the funds. So it's a rotation more than anything else. And the clients would also recognize that we, in our multi-asset portfolios, the Regulation 28 portfolios that we run, we've actually trimmed somewhat on the global equity side, but we didn't trim in South Africa because we know South Africa is so-called cheap and nasty, but it's, I think, cheaper than what it is nasty at the moment, so we're not going to sell.
Thank you, Alvin. So I'm fully aware over time, so I'm going to ask you but one quick question for you with a quick answer. So just as pretty much as a captain of industry, so just a quick one, what would be your wish list or what would you like to see from government, from Treasury, from the Minister of Finance over the next 3, 4, 5 months to re-energize this economy?
Yeah, we're going to have to make, and government will have to make and negotiate and implement very prudent financial, monetary and fiscal policies. And to a large degree, it's a bit of self-austerity that we would have to apply in the South African context. And they'd have to make some hard decisions, do some hard negotiations. And there's absolutely not a spare cent out of there. So we'd have to be very frugal as a fiscus.
Thank you, Hubert. So just from my side, again, Alvin, Renier, and specifically to Hubert, thank you very much for your time. Thank you for spending time with us. Thank you for your insights in terms of Woolworths and the bigger retail industry. To all our clients and intermediaries and brokers on the line, thank you very much for joining us. Our next webinar is in a couple of weeks where we will talk to Estienne de Klerk, CEO of Growthpoint, to get his views on the the property sector and the impact of COVID on that sector and whether there's value in that sector going forward. So from my side, thank you very much. Please keep safe and continue to talk to your portfolio managers, and we'll see you in a couple of weeks. Thank you.